Welcome everyone. We have an exciting episode today. We're going to be looking at an interview with none other than Steve Eisman. He recently was on CNBC. They asked him a lot of great questions. And I'll be honest here. There's a lot of people that go on TV and I don't think they're worth the time. I don't think they're worth listening to. Many of them just come on and they give really short-term predictions. They give one little quick take about a company or something that's pretty inconsequential. Steve Eisman's not one of those people. He's the real deal. He's someone that I think gives very valuable information. He has a long history of studying financial markets, specifically banks. He has very well-informed opinions, and he has a history to prove it. He literally bet against the big banks during the 2009 financial crisis, made a fortune doing it. He's also called many great runs on stocks. He's done a good job overall. Another thing that I like about Steve Eisman is one of the things that I think is unique is he will actually admit when he's wrong. So he'll say openly, I don't know, if he doesn't know about a subject. He'll say openly, I was wrong, if he was wrong about a subject. So he's also not one of those people that always pretends like he's correct, even though he has a great record and he's more correct than he is wrong. Now in this interview, they ask him a lot of great questions. They ask him about the US consumer. Is a consumer strong or weak? What does individual balance sheets look like for the US consumer? He's asked about the big banks. That's his particular specialty. He understands banks to a very good degree, whether they're investable or not investable. He's asked about big tech and whether you should own them right now, and a lot of other great subjects. Now we're going to start off with a question he was asked about, where a week ago he said that big banks are uninvestable, and they wanted to get an update. Has anything changed over the last week? And he sets the landscape for the US consumer. And I think that this is even more important than just a question about banks, because he explains that part of the reason banks are not investable is because of things that have changed with the US consumer.
The problems are net interest margins are still under pressure. There are about $2 trillion in excess deposits in the system that are going to continue to gradually lead. So estimates are still probably too high. You've got the regulators fighting, as I like to say, the generals fighting the last war. They're increasing the capital requirements of the banks when really what they need to do is just improve the liquidity of the mid-cap and small-cap banks. And so that'll hurt returns next year. And I mean, I have no prediction about there being a recession at all. As of now, there's no data, but let's assume there is one. You haven't had a credit cycle yet. So the only reason to invest in banks is that they're cheap, but there's one thing I've learned in my career, and I've only had to learn this the hard way multiple times, is investing in something just because it's cheap is a value trap, and shorting something just because it's expensive is a death wish.
Investing in something just because it's cheap is a value trap. A lot of investors still to this day don't understand that. And 10 years from now, there's going to be a lot of investors that still don't understand that. If a company has a low PE ratio, a low price to book, a low free cash flow or a high free cash flow yield, that doesn't mean that it's necessarily a good investment. You have to look at the quality of what you're buying, the growth prospects, where it's going to be in 10 or 20 years. So if you follow what he's saying, realize that you should not invest in something just because it's cheap. You should invest in something that's cheap, that's also high quality, and it's sold off because of invalid reasons. That's the trifecta of getting a good deal. He also mentions that he doesn't short something just because it's expensive. This is another hard lesson that has been learned for a lot of people and will continue to be in the future. Look at Nvidia over the past 2 years. People were short Nvidia just because it was expensive, and the company had tremendous momentum, blowing away short sellers left and right. I don't think there's as many people shorting stocks because they're expensive, but I think a lot of investors are buying stocks just because they're cheap. And he sees that going on right now in the big banks. The big banks look cheap, so investors scoop up shares. In reality, he's laying out all of this actual data, stuff that you can look at, that shows that they're cheap for a reason. They're not going to be good investments for the next couple of years.
I'll be on the calls. And then, thankfully, the weekend will start, so people won't be all that depressed about it.
You're also not optimistic, if I can put it that way, about the consumer. And is that
Oh, that's not fair. That's not true at all.
Oh, it's not? Okay.
You've got wrong information.
Okay.
I like how he just corrects her straight up. straight up front. She says, "You're not optimistic about the US consumer." And he says, "No, that's not true at all. You got wrong information." A lot of times, like a snippet of a sentence here will be spread around and someone will get totally wrong information. I've had that happen with me as well. I'll see stuff posted online or on different forums of something that I said that's not something I've ever said before. I don't even know where it came from. That type of thing happens all the time. So it's good to talk to the actual person or at least ask them directly if you're going to make a statement about them. But what he does here is he goes on to give his update on the US consumer. Now, the way that he looks at this is not based off of feelings, it's based off of the actual data. He looks at the US consumer and he studies their balance sheet, their spending, their savings, their job prospects, the exact same way he would a bank. So it's a way of doing fundamental analysis, but this time on the US consumer.
You like the consumer where they stand?
It's not that I like the consumer. I mean, in terms of the overall health of the economy, the consumer is fine. The consumer has savings, the consumer is employed, the consumer has income. So it's not a data point in terms of there being a recession. Where I think you could be negative is just that, rates are a lot higher. It's more expensive to buy a house. It's more expensive to buy a car. It's more expensive when people finance something. It's more expensive to put a solar panel on your house. So any part of the economy that's involved with the consumer buying something that also requires it to be financed has problems. That's not an indictment of the consumer. That's just a mathematical fact.
Any part of the US economy that requires financing has problems. That is something that he says is just a mathematical fact, and I agree 100%. I worked in the solar industry for over 5 years. Now, I was on the development side, I wasn't in sales, but I built a lot of the infrastructure for the company, and I could see all the deals we were doing and what they were financed at, and it's the same thing you can see with homes. In order to get solar panels on your roof, you usually have to finance it because they're $20,000, $30,000. Most people are not going to drop $20,000 or $30,000 in a single day. And just like with a mortgage, the interest rates dramatically change that financing calculation. Now solar panels are twice as expensive as they were a couple years ago. When interest rates go from 2% to 4% to 5%, the financing gets so much more expensive. So a lot of the companies that he's talking about here, solar companies that require financing, I would add in auto, anything to do with auto. Nobody buys cars with cash. They always pay with financing. The banks base the financing off of the federal funds rate. So cars have suddenly gotten way more expensive. And then of course the obvious one is homes. Anything in the housing market has undoubtedly slowed down over the past year. So keep in mind his comments are specific to financing. Things that don't require financing. Your Spotify subscription, your Netflix subscription, a little charges here and there. I think even going to grocery stores and going out to eat, maybe small vacations, that type of stuff that doesn't require financing, I think the consumer is still in good shape. Those products will probably do really well. It's the products that require getting a loan that are going to be hurt. And he continues on talking specifically about homes.
I wouldn't own home builders right now. I mean, they've had a great run. But the home builders have been subsidizing their customers with lower rates, but even that's going to bite. I wouldn't be involved with building products to any significant degree on the residential side. I don't think you should buy somebody who finances.
So he says that he would not be long home builders in that category. He thinks they've had a good run, but it's slowed down. I agree with him there.
I don't think you should buy somebody who finances new cars or used cars, et cetera. Anything in that universe, I think, is just going to have trouble just because of simple math.
Now, he also mentions the auto industry. A couple years ago, true story, I bought a family van. Not the most exciting vehicle, but one to get the kids to soccer and back. And that van has an interest rate of 2.2%. 2.2% is not something you can get now. So people trying to finance vehicles, they're getting rates of 6, 7, 8% now. The cost of capital is way up for financing vehicles. And to make equilibrium, prices have to go down. Tesla has been lowering prices over the past year, and I think other auto manufacturers are going to struggle even more than Tesla. But you also have other companies involved in this realm. It's not just Tesla. It's not just Ford. It's also companies like Copart that deal with repossessed vehicles. It's companies like Ally Financial that finance vehicles. When the industry slows down, every single ancillary company slows down as well. So he's saying that It's not doomsday for these companies. He's not predicting that they will implode. He's just predicting things are slowing down. They're not going to have quite as good of years as they recently had. They may struggle a little bit. Eventually, these companies will come back.
When mortgage rates were 7%, now they're 8%, but when they were 7%, for you to buy somebody out of a house where they have a 3% mortgage, for you to have the same monthly payment, the house price had to be down 40%. So now it's 50.
Wow.
That's just math. Now, no one's going to sell their house down at all if they have a job. They just won't move. So the housing market is locked. People can't buy and they can't sell. Now,
that is exactly what's happening from what I can see. Now, I know there's going to be some realtors that have different perspectives based on their location, but I have someone that's selling a house right in my neighborhood. And just a year ago, any house in my neighborhood had a line of people out the door wanting to buy them. Now that house has been for sale for a couple of months now. They're not getting as many offers. They don't want to lower the price because they are fully employed. They can wait. So it is just freezing up. Things are just slowing down with anything that requires financing, homes being the biggest thing that people finance. So he outlines the categories of industries that he thinks are in a little bit of trouble. The auto industry, the housing market, solar panels, anything else you can think of that requires a lot of financing. Those are not where he would be putting money into right now. But the question becomes, how does this resolve? What happens? The consumer's having a standoff with these industries. What changes in the future? And I think his response here is interesting.
Do they continue to not buy those things?
I think they continue to not buy those things.
And rebuild their sort of savings?
He says, I think they continue to not buy these things. And eventually consumers will regain a little bit of cash balance and probably end up buying them in the future, but it may take some time.
And then ultimately spend again, or just?
Yeah, I think that's probably what happens. I mean, like I said, you would have thought, given what's gone on with rates at this point, that the economy would be in a recession. And not only are we not in a recession, we're not even close to a recession. So, look, I'm not an economist. I think everybody should have a little humility at this point about predicting recessions. I watch your show, I watch other people's shows, I read other people. So there were people who were negative going into the year that became positive. There people who became positive were negative. They've all been wrong. So everybody should just take a step back, take a breath, and just say the data currently says there's no recession, and we'll see what happens.
Again, I think he's spot on here. We've seen so many predictions of a recession this year, and all of those people have been wrong. Everyone's saying, get short, be scared, we're in a recession this year. They've been dead wrong, and many of them to dramatic detriment of their portfolio. I recently just highlighted one of the strategists at JP Morgan, a guy that started off the year bearish. So he was bearish this year, missing out a 40% rally in the QQQ. And that's because of his prediction of macroeconomics. Steve Eisman is acknowledging that nobody has a clue what's going to happen. He doesn't have a clue what's going to happen. And he's basically doing the same thing that I've tried to do for a while, which is call it out. Say that nobody knows what's going to happen with the economy. We should all be a little bit humble, take a step back, acknowledge we don't know what's going to happen, and just look at the data we have right now. I love that he has this take. I agree with him 100%. Now, in the next part of this, they get to the question of banks. A week ago, he said banks were uninvestable. They asked him, has his opinion changed? Obviously, it hasn't. He hasn't changed his opinion in 1 week. He still says they're uninvestable, but he does highlight one bank that he thinks is the least uninvestable.
I have a joke where I say, if I was still a sell-side analyst covering just banks, I literally would write the same thing every single day. Banks are uninvestable, but if you have to buy a bank, buy JP Morgan, call me in a year.
That's it. Doesn't like the category, stay away from banks. If you have to buy one, buy JP Morgan. Now, the next topic he's asked about is shorting. Shorting because of the economy, shorting stocks because of their fundamentals. Now, he obviously has some experience in this because he's the big short investor. Listen to what he has to say here.
In our business, being early or too early is the equivalent of being wrong. The question is, how early? So if you're a year too early, you're wrong. If you're 6 months too early, you're wrong. If you're a month too early, you're a genius. So it's a question of timing. What I would say to anybody who's trying to predict a recession is, okay, I get your thesis, but now why don't we just wait for a data point that indicates that it's happening before anybody starts to make such a major call about it?
Let the data validate your thesis before you put money behind your bet. And he's saying this specifically for short selling. If you're going to short sell a stock, Let the data validate the thesis. Let it show that the earnings are going down, that the finances look worse. Or in the case of the US, let the data show. Look at the GDP, look at what's actually happening in the economy. Don't just do it based off of analysis way into the future or your thoughts on a subject. That's not data validation. Now, I would say this is equally important on the long side. If you have a thesis that a company that's always been cash flow negative is going to suddenly turn cash flow positive, it's okay to wait a quarter to have that validated before putting money behind it. You might miss an initial jump in price. It might go up 10%, but if you wait until your thesis is overall validated, then you put money behind it, you still have a long runway of gains, a long runway of that company compounding. So either way, long or short, wait until the data actually validates your thesis just a bit before putting money behind the bet. Steve Eisman doesn't rely just on stories. He doesn't rely just on thoughts about the future. He's seen over and over again how many times a great thesis without data validation turns out to be entirely incorrect. And the stubborn, bearish people this year are another example on the long list of examples of people that did not let data validate their decisions. Now, the final part of this is he does give one category of investment that he's actually bullish on. He does see some upside here.
So last time we heard you were pretty positive on infrastructure.
I still am.
Do you think, okay, I want to know if you still are, do you think the move in rates has dampened the infrastructure demand? Do you think it'll happen anyway? Because
I think it happens anyway. I mean, it's $1.2 trillion that the United States government's going to spend. It's not going to really matter what interest rates are. So that doesn't mean that there aren't parts of the infrastructure or greenification story that aren't impacted, like residential solar is definitely impacted, because yes, you could get a tax break, but if you're going to be paying triple monthly what you were going to pay 2 years ago, you may not put a solar panel on your house. So, solar was considered a growth industry, and now volumes are negative, which I think has shocked the hell out of everybody who invests in residential solar. I mean, I think there'll be a time where that'll come back. That's not uninvestable, it's investable. It's just a question of when. I think it's a little early right now.
So he says the category he remains still bullish on today, even with the rise in interest rates, is infrastructure. Now, he doesn't give any specific names. If I'm thinking about infrastructure, I'm thinking about companies like Brookfield Asset Management, big infrastructure company, maybe different utilities, maybe companies like Berkshire Hathaway that own a ton of infrastructure type of companies. But there's also a bunch of other names that come to mind. Now, finally, we get to the next big question. He's asked about big tech. Is big tech worth owning? Does he own big tech? Let's find out.
Anything that has any financing duration is a problem.
How are you feeling about the big cap tech stocks, the so-called Magnificent Seven? Are you long any of them?
Like everybody else, I am.
Okay.
I don't know if I have any more insight into them than anybody else, and I'd probably be humble enough to say I don't have any more insight into them than anybody else. But clearly,
you have to.
It's not that I don't own them because I have to. I own them because I want to.
If your benchmark,
and it isn't so much the benchmark. It's where all the dynamism is going to be in the economy for a long time. Neuberger, we had the CEO of NVIDIA in last week. I don't think I've ever seen a CEO so, let me put it in the right terms, calmly confident in my entire life. I've never seen anyone so completely relaxed and so confident about their prospects in my entire career.
Convincing then.
Yeah.
He is in big tech. He's invested in it. He actually went out to highlight the confidence that NVIDIA has, and I think for good reason. NVIDIA is on a roll. When I read reports of it, they are being incredibly aggressive. They're pricing, building out cloud computing, building out these specific chips. I think they're giving the legacy big tech companies like Microsoft, Amazon, and Google a run for their money. So NVIDIA has been quite incredible. But either way, he describes big tech as being dynamism in America, the American activity. So much commerce, so much is happening in big tech. If you try to avoid big tech or underweight it, I really think you do run a huge risk of underperforming, because you're basically trying to avoid 25% of the US economy. Imagine trying to outperform the S&P 500 while avoiding 25% of the entire economy, especially the part of it that seems to have the best balance sheets, the best leaders, the best growth prospects. So I agree with him once again. I'm big on big tech. And I think overall, Steve Eisman is one of these individuals that has a very good head on his shoulders, very good investor. He just makes very sensible investment decisions. But that's all I have for you today. Make sure you subscribe to the channel, and we'll have more videos like this in the future.